is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us this week is our good friend Craig Hemke, Turd Ferguson from TFMetalsReport. It's great to have you back.
What's up, Doc?
That never gets old, never gets old. And we had him practicing the accent before we started the show, so it's improved a bit.
I need to be munching on a carrot next time, too.
Well, it's been a long couple of weeks for gold and silver. We took last week off as both Bull Run and I, our wives, both introduced another baby to the world, so we've been keeping busy.
More stackers.
Yeah, we're stacking the kids up.
You're stacking the stackers.
I've got 3 sons now, so it's busy time.
Awesome.
In the Doc's household. But
congratulations, Doc.
I appreciate that. But getting back to the markets, it's obviously been a tough couple of weeks here for the metals. A bit of a positive sign here today. I know a lot of traders, and talking with our contacts throughout the industry, a lot of the big banks and the traders were looking for smashing gold below 1077 today, which could have opened up the floodgates. And we didn't see that on the jobs report. We saw kind of a dump and pump in both gold and silver, actually, then shot higher above the pre-BLS numbers. Silver, they beat back right around to the same level, about 1480. I guess really about the same thing. Gold closing the day just above 1090, but our worst fears were not confirmed here today. What's your take here, Craig, on the trading action really over the last couple of weeks and then through this week and today on the jobs report?
I'll try to keep it brief because I just got done recording a podcast for my subscribers of my site, so I could probably ramble for 20 minutes uninterrupted because I just did. There are a number of things in play today. One, and I'll send a couple of these charts over to you, Doc, so you can post them with this if you'd like. One, you can trace back a trend line in silver all the way back to the middle of May, which is the last time the dollar index bottomed near 93. And silver was, hell, I can't remember what silver was back then, but there's a trend line that goes straight down. And it has contained silver all the way down now for almost 90 days. We finally moved through that trend line back on Wednesday, consolidated that move yesterday, and then actually moved higher today. So it is encouraging on the daily chart to see that we're kind of turning the tide in silver. But today's trade was very instructive in terms of understanding the major players in the I mean, there's not very many of them, in fact, in this paper derivative silver market. And that if you go back to 3 weeks ago today, Friday, July 17th, silver closed at 1484. And then, of course, on Sunday the 19th, we had the $3 billion paper bombing of gold, which knocked it down $50, from which it's yet to recover. But silver, on the other hand, never really participated that much to the downside. In fact, 1484 now is the key level. We traded up against it today, got through there for a while, got all the way to 1499 before being shoved back. Actually falling 2% from those highs back down to 1470 this afternoon on no news, no move in Forex, nothing. Just a defense of that 1484 level. And why is that important? Because after all that time and effort and energy devoted to banging gold down, getting silver back above the close 3 weeks ago at 1484 puts every single silver short added in the last 3 weeks underwater. And so that level is being vigorously defended, but I'm feeling it's a losing game. And we got a lot of really good news this afternoon with the COT report, and I have a sneaky feeling that the worst, if not already behind us, is soon to be behind us. I don't know how far we'll rally because we fell through such significant support up near 1150 and up near 1550 that's in turn going to now be pretty significant resistance. But nonetheless, this idea of the floodgates opening and triple-digit gold and stuff like that, I really don't think that's coming.
What's your take, Eric?
I'd agree with his assessment for the most part. I mean, we still have yet to even see silver slice through that $14.15 spot price level back in December on an intraday basis. And silver this week has, in fact, been trying to gain its footing back ever since that gold drive-by shooting that Sunday/Monday morning or evening rather. The July 20th to today marks 10 trading days, and that's a pretty typical healing period that one would expect to see after big raids as well too. Historically, 10 days, give or take, is kind of the average trading day that you would, or number of trading days that one would need to see this kind of recovery that I've talked about before, and we've seen that pattern before. So, and we're in a stronger period seasonally. India is beginning to ramp up for their holiday season purchases. Their imports of silver are still continuing really, really high, and in excess of 30% above what they were doing at a run rate last year. And China is ramping up again now too, and there's been huge amounts of gold going into the Shanghai exchange, in addition to the outtake that comes from the offtake that's being reported there. So all of this mainstream nonsense about how gold demand, silver demand is really weakening in Asia when it's not, and then completely ignoring the significance of mints being closed down because they just can't keep up with retail demand and all of that. And then the backwardation that we see in LBMA in particular in gold is pretty telling. And James Turk's been pounding the table about that stuff, and I understand that you interviewed him recently this week as well, Turk.
He was saying the backwardation is the worst he's ever seen. Is that right?
Yeah, I did, and it that if anybody goes to TFMetalsReport, I did that for subscribers on Thursday, but it's public now, so anybody can go there and listen to it. It's about an hour, and it was just tremendous. I mean, Mr. Turk has forgotten more about the metals than probably all ever know, and brilliant guy. And yeah, one of the things we talk about early in the call is how difficult it is to assess global physical tightness, because really you're just looking at all these anecdotal data points. His example was, he said, you might be out in the jungle and grab a hold of the foot of an elephant, and you've got a foot, but you have no idea what the entire animal looks like. And that's kind of what we have. You talk about the backwardation, or you talk about the physical demand, or the mints, or the all this kind of stuff, and there are all these little data points, but you try to put them all together so that you can actually get a picture of the elephant, was what we're trying to do. I know, Doc, you can probably talk to this, just your own specific examples at SD Bullion about wholesale tightness and just that overall retail demand, which is obviously one part of the picture, but that's all part of what's going to keep the paper price from being driven much lower.
And before you dive into that, Doc, why don't we just explain what backwardation is for people who are new to that term? It costs more to purchase gold today versus in the future. Normally it would be the other way around, because you have the carry cost of storage and financing when you're putting up margin to take something off of an exchange. So typically you would see that people are basically now unwilling to wait 30 days or further out with the purchases of gold. They'd rather have it in hand now, and are willing to pay more money for it right now, as opposed to doing a transaction that would involve risk of counterparties and perhaps not even being able to get gold that you're trying to buy. And that's the significance of backwardation. And then the gold market is signaling that right now, as James Turk has been discussing all week.
Yeah, and as you're talking about that, and this desire for gold now, and in the hand, that's what backwardation is all about, and that's another data point. And Doc, I want to thank you for publishing some of the stuff that I've been writing about extraordinarily high delivery demand on the COMEX. COMEX is in the delivery market. Hell, who knows if they even have any metal there backing up all these paper contracts. If anything, it's at record high levels of leverage. 100 times, 120 times deliverable ounces. And we are seeing, instead of let me put it this way, I keep track of how many contracts for a delivery month are still open when that month goes off the board and moves into delivery, that point where it's no longer traded by traders. You have to have 100% margin in your account to continue owning it, as proof that you have the ability and the desire to actually take delivery. That's called first notice day. And so I keep track of how many contracts are still open on first notice day versus how many just simply get closed out over the course of the month, and how many then ultimately take delivery. In July, silver, that percentage of contracts that got delivered was highest that I've ever seen. It was actually more by it was 130% of what was standing at the end of June when the contract went off the board. I've never seen that before. Usually the delivery percentage is closer to maybe 70%, 60%, and instead it was 135%. And we're seeing the same thing play out in August gold. Again, just static data, anecdotal points. But when you're talking about backwardation being a sign of people wanting immediate delivery, folks standing for delivery from the COMEX and actually jumping the queue and putting up full margin to buy a contract and take delivery, that's also a data point of people wanting immediate delivery. And again, the more points we get like that, the more the full elephant comes into view.
And yeah, we've seen quite a few data points across the wholesale market on the U.S. and the bullion side that is evidencing the exact same thing. This week, the Royal Canadian Mint severely restricted their dealer allocations. They actually stopped taking orders entirely for silver maples on Thursday afternoon, pretty much shocking the authorized dealers, and they cited their reasoning as a blank issue. That tells me that they're having issues sorting the blanks, and this was after they'd already cut allocations down well over 50%. The U.S. Mint, the week before last, their total allocation for across all the primary authorized dealers was 1.4 million ounces. Last week, they only allowed a total of 1 million ounces. So again, that's a pretty good week-over-week decline in their allocation to the dealers. And then on a wholesale side, the refiners are paying about 8 cents per ounce over spot for 1,000-ounce bars premium to the spot price, which is, again, the 8 cents might not sound like much, but we're talking 1,000-ounce bars that, I mean, that's very unusual, untypical, something that hasn't been seen in the bullion market since 2008.
That's where you have such a great perspective too, Doc, because there's all kinds of folks out there that write on the internet about, the mint and how many ounces they sold in July and how many they've sold year to date and all that kind of stuff. But that they could have sold a lot more, right? I mean, the mint, ever since Tim Geithner changed the law a couple years back, that they don't have to produce all the way up to demand. They just have to produce as much as the Secretary of Treasury says he thinks they should.
Right. I mean, the U.S. Mint right now, they're only selling as many coins as they can crank out. They're not selling as many as people want to buy. And
so this idea they did 5.5 million ounces in July, and so, well, that's really not that many. Well, hell of bells, it could have been 10.5 if they actually met demand.
And I will tell you that of that 5.5 million in July, probably about 3 to 4 million was sold in 24 hours.
Yeah, that's true too. And then, how about the gold eagles? You doing a lot of those? I mean, if you look at the Mint's numbers, they sold the same amount of gold eagles in July as they sold in February through June.
Yeah, gold products across the spectrum, the demand's off the charts. The U.S. Mint was backed up a little bit. They're not as bad currently on the gold eagles, but the Canadian Mint has been about a month backed up on gold maples. And we're talking about new coins, which is, again, we haven't seen that in years. Backdated coins, they're gone off the market. Same thing for, anything that's not a freshly minted product. So 90% silver, any backdated gold coins. Good luck finding anything like that.
Didn't that tell you that physical holders aren't selling?
Yeah, exactly.
Isn't that what that means?
The only new supply is what's fresh coming out of the ground last week.
Yep. And again, that's what a scam the COMEX is, because that's not what determines price. What determines price is what the paper derivative market trades at. And the paper derivative market is just completely unregulated. The CFTC's not looking the other way. They can leverage as much as they want. They can print as many contracts as they want to meet demand and sculpt the price into whatever they want it to be. And again, until we get that true physical market, we're never going to really know for sure what the true supply, demand, and true fair price really is.
And as we discussed in the last show, Craig, it's not just the government mints. It's not just a government issue. The Sunshine Mint, which is a private mint, really in less than a week, starting with that big July, was it July 7th? The big hit was. They sold through all of their production up to pretty much October, and at which point they stopped taking sales, which is just mind-blowing. And it's pretty much the same thing at the other private mints. They're weeks out on production. Just shortages continue to spread to the market, and you can really see it cascade down from when it starts in the eagles and maples and then spreads to other coins that aren't typically sold in volume as much, like, say, the British Britannias, Philharmonics, Libertads, things like that, it's really unique and interesting to be able to see it from a wholesaler perspective. I won't name names, but one of the authorized dealers, I mean, they have, we were talking to them this week, they have over 20 warehouses full of gold and silver, and they're out, and they can't get any.
Wow.
I mean, across the U.S. and Canada, 20 warehouses that they store precious metals in, and now they're sitting there paying rent for they're not storing anything.
And again, to be clear for our listeners who are unaware, when you mention authorized dealers, you're talking about what, one of 6 or so companies that take the product from the mints and then put it out to subsequent retailers. So you're talking about a major axle in the system. You know, if they're having that much blown out of their inventory, that says quite a bit. It says that the market will probably be tighter in the weeks and months ahead, because they won't be able to rebuild that level of inventory. We've also had reports from Perth Mint and the Royal Mint in the UK as having supply issues too.
Yeah, certainly a lot of it will depend on where price goes from here. I mean, the sales action on the retail side has slowed down a little bit over the last week to 10 days. But I mean, it's already so totally gone from the market. But if you would see any further price breakdown, which is, I mean, likely why they've backed off a little bit, because they don't want to totally break the physical market, which would happen. I mean, if we see gold go down towards 1,000 or below it, and if we see silver break 14, I mean, you're going to be seeing the same type of thing you saw in 2008, where, I mean, 1,000-ounce bars go for a couple bucks over spot, and you just can't find any physical anywhere. That's what I see anyways. We'll see if it happens.
Yeah. What's amazing, too, is that it's actually mainstream expectation going back all the way to the turn of the year that we would have a silver deficit this year. And here we are, the cartel's beating the snot out of these markets, and at some point you got to wonder, well, okay, where's the industrial user going to stand and make sure that they can secure the supply that they need to make their manufactures? That's probably what's going to put a floor to the market. Silver, in fact, helping to stop the carnage in the precious metals sector across the board, simply because industrial demand at some point is going to marry up with this high level of investor demand that we're seeing and put a floor to this nonsense. So have you seen anything interesting as far as like 90% premiums and shifting of premiums in the context of this takedown since July 20th?
I mean, the last few weeks there haven't really been that much of a shift in premiums because it's no offer. So you'll talk to talk to the major market maker, whatever you want to call them in the U.S., the largest wholesaler in the country that moves the most 90% of any wholesaler in the country. And I kid you not, the last conversation I had with the head of their trade desk was, I mean, we're no offer right now because, I mean, what do you want me to tell you? 6 to 8 weeks out, $6 over spot? Like, you're not going to want that, and so let's just cut to the chase. We're no offer. Like, we don't have any, and in order for us to find any for you, we'd have to offer people ridiculous amounts of money to come up with any. So
another sentiment sign that might be interesting, and I don't know the answer to the question, I'm just asking because I know everyone else would be interested. Have you seen any shift in the ratio of new customers coming to you that have never bought silver or gold before, or maybe even as well interesting data from large buyers? You're seeing a higher concentration of really big money type customers coming to you and making big purchases now, or kind of sleepy? What do you see?
Probably a couple of weeks back, there's a high concentration of really big money coming to the market. But I would say from what we're seeing, again, this is just anecdotal to ST Bullion, not the level of new buyers that we saw last October, November.
And first-timers?
That's what I'm saying. First-timers, I don't think we're seeing quite the level that we saw last October, November.
Okay.
But big money, yeah, they were all over the place coming out, stepping up to the plate, making big purchases. Well, Turd, why don't we discuss a little bit here? You have a very interesting chart in gold that seems to indicate that the small specs may be indicating that the turnaround is imminent.
It certainly looks that way. I mean, this is the group that, I mean, I used to be a small spec myself when I traded futures. I mean, this when you get the Commitment of Traders report every week, it's either you look at it in really large categories, which we call the legacy report, or you can break it all the way down into kind of smaller categories and what's called the disaggregated report, where you can look at money, technical funds and managed money funds and producers and merchants and all that kind of stuff. But what is always the same is what's called other reportables, which is the small speculators. This is like what's left over gets assigned to, Billy Bob sitting in his basement trading, 10 gold contracts, that kind of thing. This is the ultimate, totally disconnected group, right? They think they know what they're doing. They think they have a chance to make money. This gold looks like it's going to go up or it's going to go down. And then, they call their broker and their broker says, yeah, I'll get you 5 contracts to the market. And they think they have a chance, but they don't. And these banks, as you know, completely control these markets. They lead the large speculators, the hedge funds, in and out of whatever position they want them in, with the only exception being the last 3 weeks where the large speculators actually made some money. But that's very rare when that happens. The banks are firmly in control. They have the books. They know where the orders are. They know where the physical orders are. The people that are totally lost are the small speculators. In fact, Andy McGuire told me once that the stat he had was that 90% of small traders get completely wiped out in 90 days. They lose everything they have because they buy high and they sell low and vice versa. So the very good news that I have to share with everybody is that in the latest Commitment of Traders report that came out this afternoon, the small speculators in gold are now net short at a level I have never seen in all my years of following the COT reports. So we'll call it a new all-time record, because I don't think even if you go back and ask somebody, let's follow this forever, like Ted Butler, he'd probably confirm that. The small specs in gold are now net short over 15,000 contracts. And you think, well, what does that mean, Craig? I put that in context. If we go back to May 19th, when gold was at 1220, and everybody thought, okay, hey, we're looking good for a summer rally, the small specs were net long nearly 10,000 contracts. So they were net long 10,000 at the most recent peak, and now down here they're net short over 15,000 contracts. And if you look at the chart that I've sent over to you, Doc, and I'm sure you'll post it to this page, just some of the latest peaks and valleys of price and how it's associated with the small specs either getting short at bottoms or long at tops. The last 2 times they were long was in early February after the price had run up all through January. They were long 18,000 contracts net back in early February when price was at 1280. And then, like I said, they were just long again. After getting net short in March, they were net long again in the middle of May. And now, as of last Tuesday, they weren't, net short when when they should have been net short, I guess, in hindsight at 1,300. No, they're record net short now. And what's significant about that, besides the fact these guys have a track record of almost always being wrong, they're the ones that don't have the margin to maintain significant positions when it gets overweighted like this. Because, anybody that's ever traded these things, the markets are moving against you. You start getting margin calls and you just get flushed really, really quickly. And so the small specs are the ones that are easily panicked. And that's where we sit now with a record small spec net short position. They could easily panic, and you could quite simply see a really sharp rally from here, not the opening of the floodgates. So it's not no one should rush out and say, hey, the small specs are net short, I got to buy some calls. But it is definitely something that you can hang your hat on and feel pretty good about as we head into the remainder of this month. These markets are already, from a historical perspective, both gold and silver, the paper derivative markets, are extremely bullish from a COT structure. Now, they have been since really June or July, and price has gone down. So it doesn't mean, immediately we're going to turn around. But from levels like this, historically, as we look at, say, the silver COT structure, it is historically bullish. Historically, I guess what I mean by that is usually from these levels in the past, the move has been up and not down. Same thing in gold. And so, we throw on this thing about the small specs, and it just makes me feel better. Or let me put it this way. It makes me feel more confident that the next move is not to 975 or something like that. Again, I expect in any rally, any kind of a mini squeeze, I expect pretty stout resistance at 1150 and 1550, but nonetheless, it looks like things are turning here, that the worst is past, and maybe we'll all breathe a sigh of relief in the days ahead.
It's been a while since we've breathed a sigh of relief, hasn't it?
Well, to some extent, look, I mean, Doc, I know you've been there with me every step of the way, and I've got, of course, like everybody else, I've got some silver I bought at 45, and I got some silver I bought at 35, and I haven't sold an ounce, man, and I'm not gonna, because I know why I own it. And so the fact that it's now 15, oh, great, okay, so it goes back up to 70, yip-de-doo, like, I guess that's going to make me feel a little bit better. But at this point, and there's a lot of people at TFMetalsReport that feel this way, I mean, let them blow it out. If they want to knock it down to 8, that'd be awesome, because I'm not selling any, and I know extremely confident of where this is headed long term. And Doc, if I could call you up and get a 100-ounce bar for under $1,000, oh my gosh, that would be the deal of a lifetime. So, we talk about relief and, easing of the pressure and all that kind of stuff. And I think from a mental standpoint, that would be the case. But at this point, having come down this far, man, if they want to run it down to 12, yeah, that's okay. That's not going to change my long-term picture. And all I'm going to do is use it to accumulate more at a lower price, just like the Chinese.
Well, I think you might find, though, that if silver does go to $12 or $10 an ounce, price of physical still is around 16 or 17. I mean, we saw
that's an excellent point.
We saw that with Silver Eagles a month ago with the big takedown when the price of silver crashed 80 cents in a day. The wholesale price for the coins went up $1. And, I mean, just due to the demand as well as the shortage then, people were, both at a wholesale level as well as then retail level, you were paying more for the coin after the spot price went down 80 cents than you could have the day before.
Yeah, that's a good point.
It's not wholesalers. It's not. I mean, a lot of people get mad at us and say we're trying to rip them off. Like, sorry, I don't know what I can do for you, but the price I'm paying is $1 higher right now than it was this time yesterday. I'm not trying to rip you off, but I can't sell 10,000 ounces for a $10,000 loss.
Yeah, exactly. And I go one more. I remember I've not been a fan of the miners for quite a long time. We talk about them on my site because I got a lot of people that are, and so we try to maybe find some spots where you might just slowly be building accumulated positions and that kind of stuff. But I remember writing about the HUI, the mining index, back in early 2013, when it was like 450. And looking at some of those charts and going, man, I don't know why anybody messes around with these things. Then, you got guys like Ranning Andy that are out there saying, why would you ever want to own one? And so I've never been a big miner fan. I think I got like 200 shares of Jim Sinclair stock just so I get the reports, stuff like that. But I got to tell you, they've totally been decimated. That HUI index is all the way back down to where it was in 1997. And at this point, if a company's still in business, like maybe like Keith Neumeyer's First Majestic or something, I mean, if they've made it this far, I don't know, you kind of feel like they're probably going to see it through the storm. And so I'm strongly considering at this point, with, like I said, with that HUI index being all the way back down to where it was nearly 20 freaking years ago, it might be time to just kind of dabble in a few shares here and there. Just because you may look back a couple years from now and just think, what was I thinking? My God, the HUI was 105, and I was convinced it was, that it was not the right time to buy the miners. So we might be close to that point too. If for someone that's looking to take advantage of a turnaround, but can't get their hands on physical at a low premium cost.
There are high quality miners out there that are safer than your average junior miner, for sure, to purchase. The level of despondency in the mining sector is on par with the worst period in 2008, if not actually worse than that.
Yeah.
And these things do mean revert, and frankly, policymakers, I would hope, are at least looking around the landscape right now, realizing that if they were to try to push with cartel levers further into this market and bring prices down even further, that they're just sowing the seeds of the bull market to come, because so much mine supply is going to be knocked down and out of the market if prices fall further than where they are now. We're already probably going to see something like 15-20% reduction of gold, and maybe silver is equal, just because of the damage that's already been done, the lack of financing, the mines going on care and maintenance. I mean, it's just the carnage in the industry is just insane right now.
Yeah.
And if somebody were to be the ultimate contrarian, there's hardly any asset I can think of in the world that has been beaten down more than mining shares. And, a lot of times people will criticize silver doctors and say, oh, you guys are just talking your book, you're pushing bullion, and you want to put out headlines that attract people because of the blood running in the streets, etc. Well, doctors will make a dime talking about mining shares, but for insurance perspective, there's a very strong argument to be made that I've made many, many a time over the years on our show, that owning mining shares is important because it's all about diversification. When we live in a world that's as insane as it is right now, the better diversified one is, the better flexibility you have to navigate these crazy, choppy waters. And, it's possible that in the United States in particular, there might be a time where maybe they don't do a gold confiscation, but they'll put in excess profit taxes on gold and silver to the tune of 90% or whatever, Yeah, having exposure to a percentage of ownership of metal under the ground held by a company in terms of your percentage ownership of that company holding shares, and even better still, holding those shares either directly or in the corporate registrar as opposed to your E-Trade or whatever account you got, not having the shares in the street name. I mean, that is a form of a physical asset. It gives some diversification, and it's a hard asset. It's a good thing to have when you're talking about high-quality companies. So I definitely would encourage people, without dropping particular names of companies and whatnot, go do some due diligence and find the higher-quality companies that are out there, and consider putting some of that in your portfolio as well, too, because it is important.
I can't remember who it was. Somebody made that exact point in one of my webinars within the last month, and I can't remember who it was, but I thought it was a great point. In the very unlikely scenario that gold is confiscated or windfall profits tax or something like that, an even far more unlikely scenario is that they amend the tax code within the stock market, world of equities, all the way down to a sector, and do the same thing, to the mining stocks. I mean, that's a really, really remote possibility of something like that. And so if you do think that these prices are abnormally low and that the trend is still up for all of the global macro unsustainable reasons that we bought it all in the first place, I think looking back on some of these stocks that are just beaten down to decade level lows with an index at 20-year lows probably presents a pretty good opportunity and something that people should be thinking about, just kind of nibbling away at this point.
Yeah, and we live in such crazy times that it's not very hard to imagine, a financial crash happening and then the U.S. government declaring anyone who's hoarding gold and silver as being terrorists, and, part of the problem, and the capital controls that they would put in and so forth that could impact somebody's ability to get liquidity from their physical bullion holdings might in fact be a hard thing to do. You never know. I mean, Who knows what they might require coin dealers, for example, your local coin shop. You think, you can walk down there and sell at any time. Well, guess what? It wasn't all that long ago when they were pushing Obamacare that they were going to put in the requirement to have coin dealers register 1099 filings anytime somebody sold something over $600.
That's right.
So, there's something to be said about having a little bit of shares in one's portfolio as well, too, just because of the fact that they give you options to do other things. You can think about it in terms of a prepper. The more different types of ways in which you can respond to situations just, gives you flexibility and greater assurance that you can actually monetize insurance that precious metals represent.
Great stuff, Eric.
Well, before we let you go, Craig, I know we're going to include a few of your charts in the write-up here today, but if you can let the listeners know where they can regularly access your excellent work.
Yeah, thank you, Doc. TF for Turd Ferguson, TFMetalsReport.com. We have, we've been around, if you can believe it, almost 5 years now. And you ever seen those pictures look at Obama. Look at what presidency's done to Obama over the last 7 years.
You still have all your hair?
Or like George Bush, I do, but it's sure not the same color.
That's why
it
you
was
wear that
5
hat
years.
all the time.
That's right. That's right. It's been a very interesting 5 years, no doubt about it. But those of us that are left, we're diehards, and we recognize we're all in it together. And the beauty of TF Metals Report isn't what I do. I mean, I keep people coming back every day, I suppose. But the real beauty of the site is in the collaboration of everybody that hangs out there. I know Doc, you come by from time to time. Eric, you do too. You know that. I mean, it's the input of links and thoughts and intellect from everybody that uses the site that gives the site its real allure. And anyway, I just encourage everybody to check it out. TFMetalsReport.com.
All right.
Go
ahead.
We'll put an interview, the James Turk interview link in the write-up for this show too.
Yeah, I'll make sure I send that over as well as with these couple of charts. Because again, that was pretty sick what happened 3 weeks ago. But it should be encouraging that it hasn't gotten worse. That silver is actually, they're valiantly trying to keep it below where it was 3 weeks ago. The dollar index today put in an engulfing candle, an outside reversal. Looks like it wants to start heading back down. This notion of a rate hike is just a joke. So as we get into summer, we get past Labor Day, the realization that the Fed is trapped starts to sink in again. We could very well be set up, especially from this type of commitment of trader structure, to rally into the end of the year where everybody thinks, oh, God, we're going straight down. So there's reason to be hopeful. Everybody should take the weekend and feel good about themselves. And, of course, football season starts on Sunday as well, so we got that going for us.
All right. Craig Hemke of TF Metals Report. It's always great to have you back in the show.
Thanks, Doc.
All right. We'll wrap this week's show there. So for the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.